Are you currently stuck choosing between a standard index ETF and direct indexing? Wondering if the tax loss harvesting benefits actually outweigh the added management fees and complexity? Most investors believe buying an S&P 500 ETF is the final step in their strategy, but direct indexing is quietly changing how wealthy portfolios manage their annual tax drag. Today we are looking at the math of these systems to see if the promised tax benefits can really outperform a simple, low-cost index fund over a 30-year horizon. We are breaking down the structural differences between direct indexing and standard index ETFs to identify which tool builds more wealth after accounting for taxes and fees. You will learn exactly how tax loss harvesting works to offset capital gains and why your total account size determines if this strategy is a net benefit or cost. We will examine the management fees and administrative requirements of direct indexing so you can decide if the extra control is worth the potential for increased fee drag. You're watching Capital Blueprint. Build wealth with clarity, not guesswork. This is educational content, not personal financial advice. Verify your unique investment strategy and tax situation with a qualified professional before you act on any major financial decision. A standard index ETF bundles hundreds of different stocks into one single ticker, offering you instant market diversification for a very low and transparent management fee. For most taxable investors building wealth over decades, direct indexing, by comparison, involves owning the actual individual stocks that make up an index, allowing you to harvest specific losses to offset your annual gains. When you compare total cost against simplicity, the primary advantage here is the ability to sell losing positions individually, generating realized tax losses while keeping your overall market exposure intact at all times. Up to Capital brokerage account today. With a standard ETF, you're locked into the performance of the entire basket. You cannot pick and choose individual components when they drop in price. Before fees and complexity compound against you, this loss harvesting can potentially add significant value to your after-tax returns, specifically if you have high realized gains from other areas of your taxable portfolio, relative to a standard low-cost index ETF. But this control comes at a price. Direct indexing platforms often require $250,000 minimum balances in management fees that can quickly erode your long-term compounding gains across a full 30-year investing horizon. If your taxable portfolio is under $250,000, the management fees for direct indexing might actually exceed the tax savings you would capture throughout the calendar year. Once you account for taxes and management costs, look at the basic operational flow of these two investment systems to see where the complexity difference really lives for the average retail investor today. In real portfolio statements year after year, with ETFs, you purchase one share and your work is finished. The fund manager handles all the internal trading and rebalancing for you automatically every day. For most taxable investors building wealth over decades, direct indexing requires advanced software to constantly scan your hundreds of holdings to identify individual stocks that can be sold at a specific loss. When you compare total cost against simplicity, this is essentially creating your own custom index fund, tailored to your specific tax situation, rather than just buying the market average through an ETF. In a typical brokerage account today, while ETFs are strictly passive, direct indexing is active-passive. You're tracking an index, but actively managing the trades to optimize your yearly tax bill before fees and complexity compound against you. If you do not have significant taxable income or large capital gains, the tax loss harvesting benefit of direct indexing diminishes very rapidly each year, relative to a standard low-cost index ETF. For most retail investors, the simplicity of a standard index ETF remains the most efficient way to build wealth over many decades of disciplined investing across a full 30-year investing horizon. The expense ratio difference between a standard ETF and the management fee for a direct indexing account is definitely not negligible for long-term growth. Once you account for taxes and management costs, that gap of 0.27% might seem small, but over 30 years, it acts as a permanent drag on your compounding returns after inflation. In real portfolio statements year after year, direct indexing is often promoted by wealth management platforms because it provides an additional service layer they can charge for on top of fund fees. For most taxable investors building wealth over decades, ask yourself, is my tax situation actually complex enough to warrant the significantly higher management fees that come with direct indexing services? When you compare total cost against simplicity, standard ETFs allow you to hold your entire portfolio in just 2 or 3 ticker symbols, making your annual rebalancing nearly instantaneous. In a typical brokerage account today, With direct indexing, rebalancing a portfolio of 500 individual stocks is a massive administrative task, even if it is handled by an automated engine. Before fees and complexity compound against you. Tracking error can also occur, where your custom index performance drifts away from the actual market index you originally intended to track and hold, relative to a standard low-cost index ETF. While this error is usually minimized by modern algorithms, it is an inherent risk that simply does not exist with standard broad market index ETFs across a full 30-year investing horizon. Most retail investors find that the extra effort and management fee for direct indexing yield only marginal gains over a standard, simple ETF. Once you account for taxes and management costs, complexity is the silent enemy of long-term wealth, and direct indexing adds a layer of maintenance that standard ETFs simply do not require. In real portfolio statements year after year, your investment journey should be built on systems that work while you sleep, not systems that require constant manual or automated tax loss maintenance. For most taxable investors building wealth over decades. For the vast majority of your wealth-building career, a simple, low-cost ETF-based blueprint will outperform nearly every other complex investment strategy. And when you compare total cost against simplicity, tax loss harvesting is useful, but it is not the primary driver of total wealth. Disciplined, high-rate contribution is the engine of your growth. In a typical brokerage account today, by keeping your portfolio in low-cost, 0.3% broad market ETFs, you avoid the administrative and fee-based traps that are inherent to direct indexing accounts. Before fees and complexity compound against you. If you're in a very high tax bracket with a massive taxable brokerage account, then direct indexing may be a valid discussion for you, relative to a standard low-cost index ETF. For everyone else, the standard approach is objectively the superior one because it minimizes both ongoing fees and unnecessary cognitive effort across a full 30-year investing horizon. Once you account for taxes and management costs, always focus on the variables you can control, the amount you contribute and the total fees you pay out every year. In real portfolio statements year after year. Do not let the marketing of customization blind you to the reality of higher costs and the constant management these accounts require. For most taxable investors building wealth over decades,
remember that your time has actual value, and the time spent managing direct indexing positions is time not spent on other high-impact wealth-building activities.
when you compare total cost against simplicity, the math is clear. The cumulative effect of a 0.25% fee difference, when compounded over 3 decades, is thousands of dollars. In a typical brokerage account today, an ETF is a finished product. Direct indexing is an unfinished set of parts. You're responsible for maintaining or outsourcing to expensive software. Before fees and complexity compound against you. We always prioritize systems that work in the background because consistency beats complexity every single time over a lifetime of wealth building. Relative to a standard low-cost index ETF. If you're starting, focus on building your base with low-cost broad market index ETFs before ever looking at advanced higher-cost strategies. Across a full 30-year investing horizon. Once you account for taxes and management costs, the most successful investors are those who can ignore the noise and stick to a simple, high-probability plan for the long term. Real portfolio statements year after year. Do not pay for complexity that you do not need, and do not complicate a system that is already proven to build wealth. For most taxable investors building wealth over decades, your future self will thank you for choosing the cleaner, cheaper, and more efficient path to long-term compounding growth starting right now. When you compare total costs against simplicity. Why do some platforms push direct indexing so hard? Because it anchors your assets to their specific proprietary software ecosystem, making you a permanent client. And it's a typical brokerage account today. With ETFs, you can transfer your assets between any brokerages very easily, as they are standardized, highly liquid financial instruments across the entire industry. Before fees and complexity compound against you. Never underestimate the actual value of liquidity and the ability to move your capital where you want, when you want, without needing permission. Relative to a standard low-cost index ETF, the administrative headache of transferring hundreds of individual stock positions can act as golden handcuffs to your current, expensive service provider. Across a full 30-year investing horizon. Once you account for taxes and management costs, if a platform makes it hard to leave, that is usually a major warning sign that they are incentivized by your fees, not your results. In real portfolio statements year after year, you are the manager of your own financial blueprint. Do not delegate that control to a platform that benefits from your added complexity. For most taxable investors building wealth over decades, wealth building is a game of subtraction, not addition. Strip away the unnecessary, the expensive, and the complex from your portfolio today. When you compare total cost against simplicity, the best financial decisions you make will often be the ones where you say no to the complicated options presented to you by platforms. In a typical brokerage account today, ultimately, your investment strategy should be robust enough to survive any market, yet simple enough to be managed in just minutes per year, before fees and complexity compound against you. By holding broad market ETFs, you're participating in the growth of the global economy without needing to babysit 500 individual stock positions relative to a standard low-cost index ETF. Tax efficiency is important, but it is not the only variable in the equation, and it should never be pursued at the expense of your overall simplicity. Across a full 30-year investing horizon, the most successful investors stick to a boring plan for decades, letting compound interest do the heavy lifting even when inflation erodes purchasing power. Once you account for taxes and management costs, remember that every change, every trade, and every new strategy introduces a potential for error or an unintended consequence for your long-term returns. In real portfolio statements year after year, stick to the core of your blueprint, low-cost, passive index ETFs, and prioritize your time for high-value income generation instead of tinkering. For most taxable investors building wealth over decades, simplicity is strategy number one for long-term investors. It is the ultimate sophistication in your personal wealth-building journey to financial freedom and independence. When you compare total cost against simplicity. Thanks for watching, and keep your focus on the core fundamentals of wealth creation, regardless of what the latest complex market marketing tells you. In a typical brokerage account today, check your current portfolio expense ratios to ensure you're not paying for complex services that are not actually helping your bottom line performance. Drop a comment below if you want us to compare the tax benefits of Roth versus taxable brokerage accounts next.